Welcome to the deep dive. Today we're tackling, well, probably one of the most complex tax situations out there. Being a U.S. citizen or resident alien living and working outside the United States.
It really is. The core issue right off the bat is that the U.S. tax is based on citizenship, not just residency.
Exactly. So you're subject to tax on your worldwide income, no matter where you actually, hang your hat.
Yeah.
It creates this immediate kind of intense administrative challenge.
Absolutely. That worldwide income rule is the bedrock. If you're a U.S. citizen or meet the definition of a resident alien, everything you earn anywhere on the globe is potentially on the IRS's radar.
And the basic filing requirements, the income thresholds, they're the same as for someone living stateside.
Pretty much identical, yes. That's the starting point.
Okay, so U.S. citizens are clear,
Mm?
but let's nail down that resident alien part. Who exactly falls under that umbrella, especially if they're mostly overseas?
Right. It basically boils down to two main tests. The simpler one is the green card test. If you're a lawful permanent resident of the U.S. at any point during the year, you're in.
Green card means U.S. tax resident. Got it. What's the other one, the more complicated one?
That's the substantial presence test. And this one is all about counting days physically spent in the United States.
Okay, let's unpack that. Because it's not just about this year, is it? It's a look-back calculation.
That's right. It's a two-part test, really. First, you need at least 31 days of presence in the U.S. during the current calendar year. That's the minimum entry ticket.
31 days. Okay.
And you also have to meet a 183-day threshold calculated over a 3-year period, the current year and the 2 preceding years.
And this is where that weird weighting comes in, isn't it? How does that work?
Yeah, it's a bit quirky. You count all the days you were present in the U.S. in the current year. Then you add 1/3 of the days from the first preceding year.
Okay.
Only 1/6 of the days from the second preceding year.
Huh. So it really diminishes the impact of presence further back in time.
Exactly. It's designed to catch people with significant, fairly recent presence, not someone who visited briefly years ago.
Let's use that example from the material. Say someone spent 120 days in the U.S. each year for 3 years, 2024, 2023, and 2022.
Okay, so for their 2024 status, we take the full 120 days from 2024. Then we add 1/3 of the 2023 days, so that's 120 divided by 3, which is 40 days.
120 plus 40.
And then 1/6 of the 2022 days. 120 divided by 6 is 20 days.
So 120 plus 40 plus 20. That's 180 days total.
Correct. 180 days.
Is that enough to meet the test? The threshold was 183.
Crucially, no. It falls just short. 180 is less than 183. So in that specific case, even with consistent presence, they would not meet the substantial presence test for 2024.
Wow. Missing it by just 3 days makes all of the difference. That formula really matters.
It's a huge difference. Avoiding U.S. tax residency status changes everything.
Okay, so that's the threshold stuff. Let's shift to the folks who are living abroad full-time. What's the main tool, the biggest help? In Publication 54, we're talking the Foreign Earned Income Exclusion, the FEIE.
Absolutely. The FEIE is the cornerstone benefit for most U.S. expats. It allows you to exclude a certain amount of your foreign earned income from U.S. income tax.
And that amount changes, inflation adjusted.
Yep, every year. For 2024, the maximum exclusion amount is $126,500.
$126,500.
Yeah,
That's a significant chunk of income you can potentially shield from U.S. tax.
it is. And if you're married and your spouse also works abroad and qualifies...
They get their own exclusion, too.
Exactly. Each spouse gets their own $126,500 limit, provided they both meet the tests. So potentially a couple could exclude up to $253,000 combined.
$253,000.
Yeah.
Okay, that's substantial. But getting this exclusion isn't automatic. What are the main hurdles? What tests do you have to pass?
Right. First, you must have your tax home in a foreign country. That's basically your main place of business or work. Then you have to meet either the bona fide residence test or the physical presence test.
Let's break those down. Bona fide residence.
This one is about establishing that you are genuinely a resident of a foreign country for an uninterrupted period that includes one full calendar year. It's more subjective, looking at your intentions, your ties to the foreign country. It generally applies to U.S. citizens.
So proving you've really set up life there.
Pretty much. The second test, the physical presence test, is just a numbers game.
More counting days.
Yep. You need to be physically present in a foreign country or countries for at least 330 full days during any period of 12 consecutive months. Doesn't have to be a calendar year, just any 12-month stretch.
330 days, that doesn't leave much room for trips back to the States.
Not much at all. It's about 35 days you can spend outside the foreign country or countries during that 12-month period.
Now, what if something forces you out, like a war or civil unrest? Is there any leeway there?
Yes, thankfully. There's an exception. The minimum time requirements, the 330 days or the full tax year for bona fide residents, can be waived if you had to leave a foreign country because of war, civil unrest, or similar adverse conditions.
So you don't lose the exclusion just because you had to evacuate.
Correct. But it's not automatic. The Treasury Department, in consultation with the State Department, has to officially designate the country and the time period for this waiver. And you still need to show you reasonably expected to meet the time requirements, if not for the adverse condition.
Okay, that makes sense. Now, alongside the FEIE, there's help for housing costs, right?
Yeah.
Which can be astronomical overseas.
Absolutely. There's the foreign housing exclusion and the foreign housing deduction. They work together with the FEIU.
How's the calculation work for 2024?
Well, you figure out your actual reasonable foreign housing expenses, rent, utilities, things like that. Then you subtract a base amount. You only get a benefit for the expenses above this base.
And that base amount for 2024 is?
For 2024, the base housing amount is $20,240 per year. That works out to about $55.30 per day.
So you have to spend more than $20,240 on housing before you see any tax benefit.
Exactly. And there's also a ceiling on the eligible expenses you can consider. Yes. Generally, the maximum limit for eligible housing expenses in 2024 is $37,950 per year, or about $103.69 per day.
Generally. Does that mean it can be higher?
It can, yes. For certain designated high-cost cities, think London, Tokyo, Hong Kong, the IRS publishes higher limits because they recognize the reality of housing costs there. But $37,950 is the standard cap.
Exclusion versus deduction. When do you use which?
Good question. You claim the housing exclusion if the money used for your housing came from your employer, like a housing allowance. If you're self-employed and paying for housing out of your self-employment earnings, you take the housing deduction.
Okay, exclusion for employees, deduction for self-employed. Makes sense.
Yeah.
But here's the big warning label, right? The trade-offs. Claiming these exclusions isn't always a no-brainer.
It's what we call the double dip trap. If you choose to exclude income using the FEIE, or the housing exclusion deduction,
You lose something else.
you do. Specifically, you cannot claim a foreign tax credit or a foreign tax deduction for any foreign income taxes paid on the income you've already excluded.
So no double benefit. You can't exclude the income and get a credit for the tax paid on it.
Exactly. And there's more. Claiming these exclusions also disqualifies you for that tax year from taking two very valuable refundable credits: the additional child tax credit and the earned income credit.
Wow. Losing out on those credits could be significant, especially for families. So you really have to run the numbers exclusion versus taking the foreign tax credit instead.
You absolutely have to. It's a critical strategic decision every year.
Right. Let's pivot to compliance complexities. This is where things get even more interesting. Let's talk self-employment tax. I'm a consultant overseas. I earn $90,000. I exclude it all with the FEIE. My U.S. income tax is zero, right? I'm good.
That's probably the single biggest misunderstanding for self-employed expats. The answer is no, you're not necessarily good.
Why not? The income is excluded.
The FEIE excludes income from income tax. It does not exclude it from U.S. self-employment tax. That's your contribution to Social Security and Medicare.
Ouch. So even with zero income tax liability, I still owe SE tax.
Yes. If your net earnings from self-employment are $400 or more, you have to file Schedule SE and pay self-employment tax on that income, even if it was earned abroad and excluded under the FEA.
What's the limit for that in 2024?
For 2024, the maximum amount of earnings subject to the Social Security portion of the self-employment tax is $168,600. The Medicare portion applies to all net earnings.
Let's use that example. The consultant earned $95,000, had $27,000 in deductions. Net profit, $68,000. They exclude the $68K with FEIE.
Yep. Income tax might be zero, but they still owe self-employment tax on that full $68,000 net profit. It's roughly 15.3% on most of it. That's a significant tax bill many people don't anticipate.
That is a nasty surprise if you're not expecting it. Okay, another complexity. Foreign currency, how do you handle income paid in euros or yen?
Generally, you have to translate everything into US dollars for reporting. The rule is to use the exchange rate prevailing on the day you received the income or paid the expense.
What about this blocked income situation?
Hmm.
You've earned money, but you literally can't get it out of the country.
Right. Blocked income is specifically income earned in a foreign currency that, due to governmental restrictions like currency controls, you can't actually convert into US dollars and bring out.
So what do? You earned it, but you can't access it.
You have an option. You can elect to defer reporting that income for US tax purposes until it becomes unblocked or convertible.
How do you make that election?
You have to file a special informational return with your regular tax return, essentially stating, I earned this income, it's blocked, I'll report it when I can access it. Importantly, by doing this, you waive the right to argue later that it should have been taxed back in the year it was earned.
You lock yourself into reporting it eventually.
Exactly. There's also that very specific, unusual exception for Fulbright grants, right?
What was that?
If a Fulbright grantee receives at least 70% of their grant in a non-convertible foreign currency, they might be allowed to pay the U.S. tax attributable to that blocked income using the actual foreign currency of the host country.
Pay the IRS in foreign currency.
In that very limited circumstance, yes. It's quite rare.
Definitely unique. Okay, shifting to pure information reporting forms that don't calculate tax but can carry huge penalties. Let's start with the big one, FBAR.
Right, the FBAR. FinCEN Form 114, Report of Foreign Bank and Financial Accounts. This isn't even an IRS form technically. It's from the Financial Crimes Enforcement Network.
And the trigger is?
If the aggregate value of all your foreign financial accounts, bank accounts, brokerage accounts, mutual funds, certain insurance policies, exceeds $10,000 at any point during the calendar year.
Aggregate, meaning you add up the highest balances in all accounts.
Even if one account briefly hit $11,000 for one day and the others were small, you have to file.
And the deadline.
The official deadline is April 15th, but there's an automatic extension to October 15th. No need to request it. But the penalties for failing to file can be absolutely crippling even if no tax was due.
Okay, so $10K aggregate triggers FBAR. What about FPA and Form 8938?
FATCA, the Foreign Account Tax Compliance Act, led to Form 8938, Statement of Specified Foreign Financial Assets. This is filed with your tax return.
Is it the same threshold?
No, the thresholds for Form 8938 are generally much higher than FBAR and vary depending on your filing status and whether you live abroad. For example, for a single taxpayer living abroad, the threshold might be $200,000 at year-end or $300,000 at any point during the year. It covers a slightly different, sometimes broader range of assets than FBAR, too.
So you might need to file one or both or neither.
Precisely. And then there are even more complex forms if you have ownership in foreign corporations, Form 5471 partnerships, Form 8865, or trusts, Form 3520. It gets deep fast.
Okay, let's talk logistics. Filing deadlines from overseas. We know the standard U.S. deadline is April 15th.
Right. But if you live outside the U.S. in Puerto Rico on April 15th, or if you're in the military on duty outside the U.S., you automatically get an extra 2 months to file.
So June 15th becomes the deadline.
It becomes the deadline to file, yes. An automatic 2-month extension to June 15th.
Does that extension also cover paying any tax owed?
No, that's the critical point. The extension to June 15th is only for filing the return. Interest is always charged on any tax not paid by the original April 15th due date.
Oof. So even with a June 15th filing extension, you should estimate and pay by April 15th to avoid interest.
Absolutely. If you expect to owe tax, pay by April 15th, file by June 15th.
What if you need even more time? Maybe to gather documents or, importantly, to meet those residency tests for the FEIE.
If you just need more time to file beyond June 15th, you can file Form 4868 by the due date, April 15th or June 15th, for an automatic 6-month extension, typically pushing the filing deadline to October 15th.
The standard extension.
But if the reason you need more time is specifically to meet the time requirements for the bona fide residence or physical presence test to qualify for the FEIE or housing exclusion.
There's a special form?
Yes, you file Form 2350, Application for Extension of Time to File U.S. Income Tax Return. This generally gives you an extension until 30 days after the date you expect to qualify for the exclusion.
Now, the tax landscape is always shifting, especially internationally. What are the key treaty updates for 2024 mentioned in our sources?
Big changes here. First, the income tax treaty between the U.S. and Hungary was terminated. That's effective for tax years starting on or after January 1st, 2024.
So no more treaty benefits there. Any new ones?
Yes, a new income tax treaty between the U.S. and Chile entered into force. It became effective February 1st, 2024 for things like withholding taxes and generally January 1st, 2024 for other taxes.
Okay, Hungary out, Chile in. Anything else?
A significant development with Russia. Large portions of the U.S.-Russia income tax treaty were suspended by mutual agreement effective August 16, 2024. That changes the rules significantly for anyone with ties there.
Wow, it really underlines the need to stay current.
Definitely. Treaties can override general tax rules, so changes have a direct impact.
And speaking of impact, let's talk about a really serious consequence of falling behind on taxes.
Your passport.
Under the law, the IRS is required to certify taxpayers who owe a seriously delinquent tax debt to the State Department.
Seriously delinquent meaning?
It's a specific threshold, adjusted for inflation, but generally over $50,000, including penalties and interest, and where the IRS has already filed a lien or levy.
And what happens when the IRS notifies the State Department?
The State Department generally will not issue a new passport or renew an existing passport for that individual. And crucially, they can even revoke a current passport. Revoke your passport. That could leave you stranded overseas or unable to travel for work or family.
Exactly. It ties tax compliance directly to your freedom of movement. It's a powerful enforcement tool.
A very strong incentive to stay compliant. Okay, one last quick reminder. If you don't take the FEIE, you have the choice between the foreign tax credit and the foreign tax deduction to offset double taxation. Which one is usually better?
Almost always the credit. The foreign tax credit, which you calculate on Form 1116, reduces your U.S. tax liability dollar for dollar. The deduction just reduces your taxable income like any other itemized deduction.
So the credit gives more bang for your buck.
Generally, yes. The key rule, though, is consistency. You have to choose one method, either credit all eligible foreign taxes or deduct all of them. You can't mix and match in the same year. And remember, you can't claim either for taxes paid on income you excluded with the FEIE.
Right, no double dipping rule. Okay, let's try to wrap this up. For you, the core message is, yes, there are significant benefits like the FEIE, but compliance is absolutely critical. Key takeaways from today. Know that 2024 FEI limit, $126,500. Understand the bona fide residence and physical presence tests. Don't forget the self-employment tax trap. And be vigilant about FBIR in Form 8938, reporting that $10,000 FBIR threshold catches many people. And most importantly,
file a return. Even if you think you owe nothing because of the FEIE, you generally still have a filing requirement, and you must file to claim the exclusion in the first place.
Okay.
When you choose to claim the foreign earned income exclusion, that election stays in effect for future years unless you actively revoke it.
Okay, so it carries forward.
Right. But let's say a few years down the line, your situation changes, and the foreign tax credit suddenly looks much better than the FEIE, so you revoke the exclusion election by claiming the credit instead.
Makes sense.
But if within the next 5 tax years after that revocation, you decide you want to go back to claiming the FEIE again, you can't just do it automatically.
You need permission.
You need IRS approval. You have to request a formal ruling, and they don't grant it automatically. So that initial decision to claim the FEIE and any decision to revoke it has potentially binding consequences for years to come. It really highlights how critical, careful long-term planning is in the expat tax world.
That's a fantastic point. The long game matters. Well, hopefully this deep dive gives you a solid foundation. Use this knowledge, but always, always consult with a qualified tax professional who specializes in international tax issues.
Absolutely essential.
Thanks for joining us on the deep dive.